Hello and welcome to Bazaar Ki Baat. In today's episode, we will be talking about normal market update, impact of elections on the markets, and how has SGB really turned out to be an investment for the investors. But before we begin, I would want to call out that these episodes is purely from a perspective of financial education. No amount of what we discuss transpires to be an investment advice, and we would urge you to consult your advisor before making any investment decision. Good morning. It was a great month for the equity markets. Nifty 50 rose around 6%, but mid and small caps actually outperformed them by almost closing at 9.5% for the month of November 2023. What's your view on what is fueling this rally?
Yeah, I think the one of the major reasons for which is fueling this rally is the FPI flows, which have turned positive again for the month after 2 months of consolidation. And if this continues this month also, we are definitely in for a Santa rally. The Q2 earnings season, on the other hand, ended on a mixed note. We had slowing expansion in revenue, even as profits remained robust. So if we take a quick look at using trend lines analysis of more than 3,500 companies, it showed that revenue growth of only 4.1%, operating profit grew more than 30%, right? So overall, I think the earnings momentum continued. So while we are seeing some slowdown on the revenue front. Going forward, I think one important fact is that we saw the results of assembly elections with BJP sweeping polls in almost three large states. And this can actually provide a big boost to the market confidence. And we are seeing this in the last few days. We can also continue to see this run up in in pre-2024 election. And largely, the market confidence boost from political continuity augurs well for the Indian markets. Right. And on the global front, we are seeing signs of cooling off of US Treasury yield. They have corrected meaningfully from the highs of more than 5% to now close to approximately 4.2%. And this can be another big boost to a high growth EM country like India.
Right. Right. So we will talk about elections in a bit, but I think what you said about, high rate hikes being cooling off in the US and several other parameters that are working out for the Indian markets, I think it's reflecting across all the sectors. Most of the sectors have done well in November. Specifically, if we look at the capex heavy sectors of, let's say, realty, oil and gas, utilities, they have actually delivered more than 10% returns in the month of November 2023. Kshitij, we have just closed the second quarter earnings season, and what's your take on how corporate India is doing in terms of performance numbers on revenue and profitability?
Yeah, so if we look at the revenue growth numbers, they are moderating, though we are still growing, but they have moderated. In terms of sectors, only pharmaceutical and real estate are reporting high double digit. Apart from the slow underlying growth, the reason for this, apart from external underlying slow growth, there are two other reasons which are impacting the revenue growth. One is obviously the moderating inflation, which is leading to lower pricing. And also there was a shift of festivities from the second quarter of the last year to the third quarter in the current financial year, which is also showing in the numbers. Largely, what we are seeing is a margin expansion, which has boosted the earnings growth, even when the revenue growth has moderated. And that has largely come on account of the commodities prices cool off, which provided a big boost to the India earnings. Especially, we are seeing, with the exception of IT and communication services, most of the sectors have showed improved margins on account of commodities cool off. So, yeah.
Hmm. So I think you're right. If we look at the top line has not been growing, but profitability numbers, look really great if I look at these kind of numbers. But when we look at a sectoral divide of, these performances, what do you think? What is leading and what is lagging in Indian sectors?
Yeah, so for that, I'm just relying on this interesting chart from Bank of Baroda report, which I came across a few days back. So this beautifully depicts which are the sectors which are showing high revenue growth and high profitability growth, and which are the sectors which are doing not so well on the both front, and some of the sectors which are lying somewhere in between. Obviously, the banks and financial services has been the sectors which are leading from the front, and this has been the case in the last few quarters also. Both the profits as well as sales growing more than 20% for banks, though banks we can actually difficult to look at as sales, but even then the earnings growth has been quite good. This is largely on account of good credit demand, higher interest rates, improved asset quality, which is leading to higher profitability for the banks. And this is also true for other financial services companies, which comprise of NBFCs and HFCs, etc. On the other sectors which are doing well are the infrastructure-oriented sectors, which you talked about in the previous slide. These are industries and capital goods. They have also done reasonably well. This also holds true for real estate and construction materials companies. Auto sector, if you see slightly in the chart, auto sector has also recorded a good performance in terms of both sales and profits, registering double-digit growth. Strong demand has been one of the major reasons for such performance. There is easing semiconductor issues and lower commodity prices, and this has been a big theme across the sectoral performance this quarter. The lower commodity prices, and this has boosted profits for most of the sectors. And this will probably be the biggest worry going forward if the growth has been slowing down on the revenue front, and if the commodity prices uh, do not fall further from here and consolidate here, then we may have challenges both on the margin front also, and which we have to see how going forward. On the other hand, when we talk about lagging sectors, I think IT is well known. The large IT companies have actually cut down their guidance, and they have been so much exposed to the external slowing growth that their revenue has been impacted. Also, domestically, the rural oriented sectors, which are dependent on rural demand, are the ones which are facing the brunt, because there has been a clear urban rural divide in India. The urban demand has picked up quite handsomely after COVID, while the rural has struggled, and this has continued. This year's patchy monsoon has also not helped. That has also impacted the rural demand, and this has been one of the primary reasons for weak performance of companies like FMCG. And you will see this across their commentary for this quarter. All the management commentary has been focused on how, though the margins have expanded, the volume growth has not come in due to the rural demand pickup not being there.
All right. Interesting, interesting. So I think mostly it's the slowdown in the rural demand that is impacting some of the sectors here. Banks, I think, had been doing well for the last few quarters, but I think that view is interesting in terms of what really drives short-term revenue and profitability growth for companies. There's been a lot of talk about it being an election year. There's a lot of murmur how the markets will be doing. Do you think there is any correlation between election years and how the equity markets in India perform?
Yeah, over the long term, see, it's very difficult to draw a correlation, because over the long term, stock markets have generally exhibited positivity. Election, like any other event, can only contribute to short-term volatility. So, but even then, let's say if we look at the data which I've prepared and I'm sharing here, looking at the some of the how the markets have performed in the run-up to the election and how the markets have performed post the election. If we see, the markets have shown there's no clear trend, but normally markets do well in the run up to the elections, and there has been cases of doing exceedingly well. Like in 2009, there was a sharp rally in the last 3 months leading up to the elections, where the market recognized that there is a possibility of that there is a possibility of repeat of the government. So stock markets are typically, and if we talk about the post-election markets, they've typically exhibited stability following the election, and this can actually provide a favorable environment for investors who remain invested after the election. So basically, even if we believe that the markets are going to rally from here in the run up to the election, though there have been cases where it has not, but largely on average they've done well in the run up to the election. The markets have not fallen off the cliff mostly post the elections, until unless there is a hung parliament and there is a big differential between the market expectation and the outcome, which has normally not been the case. If the market, for in the current scenario, if you believe that this there's going to be a continuity to the political outcome, and maybe the BJP is going to win, and this has been boosted by the assembly elections result, and it may be a good idea to continue to be invested. I may not, considering the valuations have been stretched, I may not suggest that you chase the market, but being invested and continuing your SIP may be a good idea.
Right. So I think there it's we are really looking up and watching how markets do this time, as we run up to the election in 2024, and we will be tracking this data, and probably we'll be able to watch this space and talk more about it next year sometime. But elections or no election, Kshitij, I am a firm believer in the Indian growth story, and I think for any investor out there, it is important to look at the broad picture and think about the potential that India has in terms of wealth creation, and not get so influenced by short term events. Because clearly, from the data that you are showing, there can be years when the expectations really don't come true, and these short term events could actually jeopardize a lot of our investing decisions also. So thank that this was very insightful. We will now move on to our next topic, which is going deeper into sovereign gold bonds. Last month, we had spoken about how sovereign gold bonds are relatively a better instrument in terms of taking gold exposure. So, welcome, Vikas. Good morning. Before we deep dive into how they have panned out as an investment, would you take us through what makes SGBs a differentiated instrument? What are some of their characteristics that people need to be aware of before they go and invest here?
Hi, Shruti. So yeah, last month we did discuss about the various forms of investing in gold, and we were of the opinion that SGB is one of the better ones. It has some advantages which helps you generate higher return in the long term. There are other advantages also like storage and safety. So I have just prepared a small slide where we are trying to say that if you want to invest in SGB, you get first the returns are more like you get an extra 2.5% over and above the gold return that you get. Then see what happens is that I was back in my home and I was seeing that people were even buying like gold bars and all. What happens is that there is an additional cost of buying and selling, which is a transaction cost, which is not there in SGB. So which adds to a significant kitty in terms of your returns. There's no GST, there's no making charges. So if your purpose is pure investment, then SGB helps you save those kind of transaction charges, which is significant if you see your actual gold purchase value. The other thing on the short term side, there's not much differentiation. The capital gains are taxed at slab rate, but the advantage comes when you start investing in gold for slightly longer period of time. So if you're investing for a period of 5 years, SGB can give you indexation benefit. So you get indexation benefit and your long-term taxes are reduced by the inflation that is in the economy, which adds to your return. And the best part, which is only available to SGB, is that if you hold it till maturity, which is 8 years, you get your money completely tax-free. So very few investment vehicles are available where you can create wealth without taxes. So this is one of the unique features which can be easily harnessed by individual investors if they.
Interesting. So, because 5 days back, we saw the first tranche of sovereign gold bonds maturing. And how did it really pan out as an investment for investors who had invested back in 2015 in the first
Yeah,
tranche
so
of SGB?
yeah, so this was, I think, a milestone event in the HGB investment journey. We saw the first investors make actual money. They saw the money flowing in the bank account. It was redeemed. So the actual investment value for that those set of investors was 2684 for gold, and it was redeemed at 6,132, which is the prevailing gold price, which was identified by Indian Bullion and Jewelers Association. Whatever is the 99 carat gold value is assigned to your redemption value. So this translated to like 3,448 rupees per unit, which is a price gain of like on a CAGR. So we always try to say that you should see what is a CAGR in investment. So if you stayed invested for 8 years, the price return was 10.9% CAGR. You got additional 2.75% interest, which was available back then. So right now, SGBs are yielding 2.5%, but back then you were receiving 2.75. Please note that 2.75 is calculated on an investment value. So this is calculated on 2684, which was your investment value. But yeah, when you add up all these returns, you were able to get a 12.9% CAGR on your investments. The price return, the important point to note over here is the 2.75% interest was taxable. The price return, which was 10.9% CAGR, was completely tax free. So this 3448 per unit was completely tax free for individuals. So which definitely makes a solid case that you can allocate as per your asset allocation to SGB. So this is just SGB which is having these kind of advantages.
Right. And I think 12.9 is definitely not a bad return for a sovereign backed instrument. And most of this ended up being tax free. So even if we ignore the 2.75, which was slightly higher than what is prevailing now, I think it's still made for a very, very good investment decision for those who invested in November 2015. But because I had a small question here. So you said that the redemption was done at 6132 per gram. How is this price of redemption calculated?
So this is calculated at a simple average of the 999 purity gold closing price in the preceding week of the redemption date. So this was redeemed like last 5 days. So like 20th to 24th November, whatever is the average value of 99.99 carat value, that is how you get to know. So which is very, very actual transaction price, and there's no kind of loading in this. So what happens is that if you go to a jeweler and buy gold, so he will add like say on 6132, he will say that if you want to buy, you can buy at 6172, and if you want to sell, you can sell at 6100. So this is a value which is available only on, like I would say, electronic redemption, because when you do a physical kind of buying and selling, you always are on the losing side.
Right, right. And I think the only demerit about sovereign gold bonds is that the issue window is decided by the government, and we've had just two windows in 2023. So the opportunity of investment is very, very limited. And those who actually want to make this investment have to be prepared well in advance. But overall, Vikas, do you think that this is an investment worth looking at? This should be an allocation that people should be taking in their portfolios?
Yeah, hi. So you had one, like you said that the issue window is available for 2 months. So yeah, this is a limitation. One thing that I like try to advise people, if say suppose you find that gold is making sense at certain price to you, or if you want to plan your SGB investments, you can always do a MF SIP in gold till the time the SGB issue comes. When the SGB issue comes, you can redeem those gold MF SIPs and you can redeem like invest in SGBs. What happens is that you can even reduce the price risk of gold if you like, if say suppose in April you want to do it and if the issue is coming only in December, so you can start your investments via gold sips in mutual funds, and then you can move to SGBs when the issue comes. So you can plan it well if you have studied all these instruments well in advance. In terms
Hmm.
of gold, see, I personally feel that gold makes a lot of sense to individual investor portfolios. The predominant reason for this, I would say, is that it has negative correlation with equity at a lot of economic and geopolitical events. So I'm not saying that at every equity correction you will see that gold prices are going up, but there are a lot of instances where you can see that gold is negatively correlated to equity. So whenever you have a high equity allocation into your portfolio, this can definitely help you in a lot of times navigating through the volatility. Also, I just wanted to introduce to a small concept of Lindy effect, which I studied and I believe in it, that the longer something survives, the chances of it surviving longer is higher. So this is how gold has been. We have seen gold survive various cycles. Like so that in itself has some credibility to gold as an investment instrument. So there would be some people who will have contradicted the opinion, but this is what I see gold as an investment vehicle. I was also seeing this interesting chart, which is the last 20 years chart between the Fed when the Fed pivots. So we have seen that the Federal Reserve has raised rates like at one of the highest rates in the history, and we we may see that the Fed may want to pause now if inflation is under control. And what we see in the last 20 years that whenever Fed starts to pivot from an increasing rate environment to reducing the interest rate or pausing it, we see that gold as an asset class has done well. So this is not something which may plan out again. We don't know because markets are always, nobody can predict the markets, but this is an interesting data point which you can always keep in mind that whenever the go like Fed has pivoted in the last 20 years, we have seen gold as an asset class do well.
Right. I think it's very interesting. And again, just like we'll be watching out the election year of investing, I think we'll also be watching out what happens to the gold prices if Fed turns around and pauses interest rate hikes or reduces them in the future. I think it really helps us learn how different asset classes move and how
Yeah.
diversification really helps in portfolio building. So thank you
Yes.
very much, Vikas. This
Yeah.
was again very, very insightful. And thank you to our viewers for tuning in and watching us. And stay tuned for the next episode next year. Thank you so much.